Two nations, no shared border, no formal war. And yet, for decades, their conflict has rattled oil markets, spooked global investors, reshaped alliances, and sent tremors through every major economy on Earth. One is the Middle East's most powerful democracy, nuclear-capable and backed by the world's largest military superpower. The other commands the region's largest army, funds an arc of proxy militias that stretches from Iraq to Lebanon to Yemen, and sits atop the world's fourth-largest proven oil reserves. This is not just a story about missiles and militias. This is a story about money, energy, and the invisible financial threads that tie geopolitical conflict to your mortgage rate, your fuel bill, and your investment portfolio. In the next 10 minutes, we're going to unpack the Iran-Israel conflict from a financial lens, what it has already cost, what it is currently costing, and what it could cost if things escalate further. Fasten your seatbelt. To understand the financial stakes, you first need to understand why two countries with no shared border have become the Middle East's most dangerous adversaries. Before 1979, Iran and Israel were actually close partners. Both were non-Arab states, surrounded by Arab neighbors. Both had strategic relationships with the United States. Iran was one of the few Muslim-majority countries that had informal ties with Israel. Trade flowed. Intelligence was shared. Iranian oil reached Israeli refineries through a secret pipeline. Then came the Islamic Revolution. In February 1979, Ayatollah Ruhollah Khomeini overthrew Shah Mohammad Reza Pahlavi and established the Islamic Republic of Iran. Almost overnight, the strategic calculus flipped. Khomeini declared Israel an illegitimate state, what he called a Zionist entity, and framed its destruction as a religious and political imperative. The embassy in Tehran was handed over to the Palestine Liberation Organization. Israel became enemy number one. Over the subsequent decades, Iran built what military analysts call the axis of resistance, a network of proxy forces designed to encircle and pressure Israel without engaging it directly. Hezbollah in Lebanon, Hamas and Islamic Jihad in Gaza, the Houthis in Yemen, militias in Iraq and Syria. Each of these groups receives Iranian funding, training, weapons, and strategic direction. For Israel, this network represents an existential threat. For Iran, it is strategic depth, the ability to project force across the region and keep adversaries off balance without exposing the Iranian homeland to direct retaliation. That dynamic, the shadow war, the proxy conflict, the constant low-level escalation, is the baseline from which we now need to calculate the financial damage. Let's start with the most obvious financial nerve in the Middle East: oil. Iran produces approximately 3.2 to 3.4 million barrels of oil per day, a significant chunk of global supply. More critically, the Islamic Republic has the power to disrupt or completely blockade the Strait of Hormuz, the narrow waterway through which roughly 20% of the world's traded oil and 18% of global liquefied natural gas passes every single day. Every time tensions between Iran and Israel spike, oil traders around the world hold their breath. In April 2024, Iran launched its first-ever direct military strike on Israeli territory, a barrage of more than 300 drones and ballistic missiles. It was intercepted with over 99% success by Israeli, American, Jordanian, and British defense systems. But markets didn't wait to see how the interception went. Brent crude oil jumped nearly 4% within hours of news of the imminent attack. Gold, the classic safe haven asset, surged past $2,400 per troy ounce for the first time in history. The volatility index, or VIX, Wall Street's so-called fear gauge, spiked sharply. In October 2024, Israel retaliated by striking Iranian military facilities, including radar and surface-to-air missile infrastructure. Again, oil spiked. Defense stocks surged. Market indices in Asia, Europe, and the United States all moved. Not dramatically, but noticeably. Investors repriced geopolitical risk. Now here's the crucial point, that April 2024 exchange was actually contained. Both sides de-escalated relatively quickly. Iran accepted a face-saving diplomatic outcome. Israel demonstrated its missile defense superiority without triggering a wider war. And yet the financial ripple effects were global and immediate. What would happen if the next exchange was not contained? If Iran were to close the Strait of Hormuz, even partially, even temporarily, the International Energy Agency estimates that global oil prices could surge between 30 and 50% within weeks. For a world economy already dealing with inflation pressures, that kind of energy shock would be catastrophic. Airlines would bleed cash. Supply chains, already fragile after the COVID disruptions, would buckle again. Emerging market economies, which are more dependent on cheap energy imports, would be hit the hardest. The Bank of International Settlements has modeled scenarios in which a major Middle East oil disruption adds between 1.5 and 3 percentage points to global inflation, which would force central banks, including the US Federal Reserve and the European Central Bank, to keep interest rates elevated for longer, deepening pain for mortgage borrowers, businesses, and governments carrying large debt loads. For Israel, the financial toll of being at the center of this conflict is staggering, and it has been accelerating since October 7, 2023. Let's set the stage. On October 7, 2023, Hamas launched the deadliest terrorist attack in Israeli history, killing approximately 1,200 people, taking over 250 hostages, and triggering a full-scale military response that would become known as Operation Swords of Iron. But here's what the financial headlines often miss. That attack didn't happen in a vacuum. It was enabled and supported by Iran, which had trained Hamas commanders, funded the military wing of the organization, and supplied the rockets and intelligence infrastructure that made the operation possible. The economic consequences for Israel have been severe. 4.1. Defense spending. In fiscal year 2024, Israel's defense budget exceeded $27 billion, representing over 5.3% of GDP. That's one of the highest defense-to-GDP ratios of any advanced economy in the world. Compare that to the NATO target of 2%, which most European countries still struggle to meet. Each Iron Dome interception costs between $40,000 and $50,000. The David Sling system costs approximately $1 million per interceptor. The Arrow 3 ballistic missile defense system, used to intercept Iran's long-range missiles, costs between $2 million and $3.5 million per shot. During the April 2024 Iranian barrage, Israel fired dozens of these interceptors. The bill for a single night of defense, hundreds of millions of dollars. The United States Congress has approved billions in supplemental military aid to Israel since October 2023, but the operational costs that Israel absorbs domestically are a significant fiscal burden. 4.2. Economic contraction. Israel's GDP contracted by approximately 19.4% on an annualized basis in the fourth quarter of 2023, according to the Central Bureau of Statistics. That is not a typo. The economy essentially went into shock following October 7th, as hundreds of thousands of reserve soldiers were called up. Northern communities near the Lebanese border were evacuated, tourism collapsed, and foreign investment dried up. Israel's credit rating, once the envy of the region, came under pressure. Moody's downgraded Israel's credit rating for the first time in its history in February 2024, citing significant deterioration of Israel's fiscal strength and rise in its military and political risk. That downgrade carries real costs. It raises borrowing rates for the Israeli government, making every shekel of public debt more expensive to service. 4.3. Tourism collapse. Tourism is normally a $7 to $8 billion annual industry for Israel. In 2024, international arrivals collapsed by more than 75% compared to 2022 levels. Hotels in Tel Aviv, Jerusalem, and the Dead Sea region reported near zero occupancy from foreign visitors. Airlines suspended dozens of routes. The ripple effects hit restaurants, cultural institutions, tour operators, and retail across the country. 4.4. Northern border displacement. Approximately 80,000 to 100,000 Israeli civilians were displaced from communities in the north, near the Lebanese border due to Hezbollah rocket fire. These communities include some of Israel's most productive agricultural regions. The cost of housing displaced residents, compensating farmers for lost crops, and eventually rebuilding communities has been estimated by the Israeli government at tens of billions of shekels over the medium term. When you add it all up, the direct military costs, the GDP contraction, the credit downgrade, the tourism collapse, and the displacement costs, the financial damage from this one cycle of escalation is likely to exceed $100 billion when fully accounted for. That is an extraordinary burden for a country of just over 9 million people. Iran, meanwhile, is paying a very different kind of price, one that is slower burning, but in many ways just as devastating. The cornerstone of Iran's economic pain is sanctions. Layers and layers of international sanctions imposed primarily by the United States, the European Union, and the United Nations in response to Iran's nuclear program and its support for terrorism and proxy militias. 5.1. The oil sanctions regime. Before the Trump administration's maximum pressure campaign began in 2018, Iran was exporting approximately 2.5 million barrels of oil per day. Under maximum pressure, that figure collapsed to under 400,000 barrels per day by 2020. The lost revenue during that period is estimated at hundreds of billions of dollars. Sanctions have forced Iran to sell oil through a labyrinthine network of intermediaries, ghost tankers, and shell companies, primarily to China, and to a lesser extent, to other Asian buyers willing to ignore U.S. secondary sanctions. But this shadow trade comes at a massive discount. Iranian oil often sells at $10 to $20 per barrel below market price, because buyers are compensating themselves for the legal and reputational risk of dealing with a sanctioned state. 5.2. Currency collapse. The Iranian rial has been in freefall for years. In 2012, one US dollar bought approximately 12,000 rials. By 2024, $1 buys more than 580,000 rials. That represents a catastrophic loss of purchasing power that has devastated the savings and living standards of ordinary Iranians. Inflation has regularly exceeded 40 to 50% annually. Staple goods, bread, rice, medicine, have become increasingly unaffordable for middle and lower income households. 5.3. The proxy cost. Funding its axis of resistance is expensive. Iran reportedly allocates between $2 and $3 billion annually to Hezbollah alone, covering salaries, weapons procurement, infrastructure, and social programs in Lebanon that allow the group to maintain its political base. Add Hamas, the Houthis, Iraqi militias, and Syrian support, and the total proxy expenditure likely exceeds $4 to $6 billion per year. This is money that could be invested in Iran's crumbling infrastructure, its healthcare system, or its universities. Instead, it is exported across the region in pursuit of a geopolitical strategy that enriches military commanders and clerics, while ordinary Iranians queue for subsidized bread. 5.4. Brain drain. Perhaps the most damaging long-term cost is invisible on any balance sheet: the exodus of educated, skilled Iranians. Doctors, engineers, scientists, entrepreneurs, and artists have been leaving Iran in record numbers. Iran has one of the highest brain drain rates in the world, according to the International Monetary Fund. Every educated young Iranian who leaves takes with them decades of potential economic productivity, and diminishes the very human capital that would be needed to build a more prosperous Iran in any future post-sanctions scenario. We've looked at the direct costs to Israel and Iran, but the financial shockwaves of this conflict extend far beyond those two countries, and they affect you wherever you are watching this from. 6.1. Shipping and insurance costs. The Houthi campaign in the Red Sea, enabled by Iranian weapons and strategic direction, has been one of the most underreported economic stories of recent years. Beginning in late 2023, Yemen's Houthi movement began attacking commercial shipping in the Red Sea, targeting vessels they described as linked to Israel or to Western nations supporting Israel. The result was a dramatic rerouting of global shipping. Container ships that previously passed through the Suez Canal, one of the world's busiest trade arteries linking Asia to Europe, began diverting around the Cape of Good Hope at the southern tip of Africa. That adds roughly 10 to 14 days to voyage times and thousands of miles of additional fuel consumption. Global container shipping rates surged by more than 300% from their pre-crisis lows during the height of the Red Sea disruption. War risk insurance premiums for vessels transiting the Red Sea corridor spiked by multiples of their normal rates. Major shipping lines, Maersk, MSC, CMA CGM, suspended Red Sea transits entirely, triggering delivery delays across consumer electronics, textiles, automotive parts, and dozens of other supply chains. The World Bank estimated that the Red Sea disruption alone added between 0.2 and 0.5 percentage points to global inflation, a seemingly small number that translates to billions of dollars in additional costs for businesses and consumers worldwide. 6.2. Defense industry winners. Every crisis has its beneficiaries, and the Iran-Israel conflict has been a windfall for defense contractors. Raytheon, now RTX, manufactures the Patriot missile system and supplies key components of the Iron Dome ecosystem. Its stock has significantly outperformed the broader market since October 2023. Lockheed Martin, maker of the F-35 fighter jets that Israel operates and the THAAD missile defense system, has seen its order book swell. L3 Technologies, Northrop Grumman, and BAE Systems have all benefited from elevated defense procurement cycles driven partly by the demonstrated effectiveness of Israeli air defense in intercepting Iranian ballistic missiles. European defense companies have also experienced a renaissance. Germany's Rheinmetall, Sweden's Saab, and France's Thales have all seen order books expand as European governments, spooked by the Russia-Ukraine war and Middle East instability simultaneously, accelerate their own defense spending. 6.3. Safe haven asset. Surge gold has been one of the most reliable financial barometers of Iran-Israel tensions. Every significant escalation moment sends investors racing to gold as a store of value during uncertainty. The precious metal broke through multiple all-time highs in 2024, driven in part by Middle East risk premiums baked into safe haven demand. The US dollar, despite America's own fiscal challenges, has also strengthened during escalation moments, as investors globally pull capital toward the world's reserve currency when geopolitical risk rises. That dollar strength, paradoxically, hurts emerging market economies, which often borrow in dollars and find their debt burden increasing when the dollar appreciates. Everything we've discussed so far assumes a conflict that remains, in military parlance, below the threshold of existential escalation. But there is one variable that changes every calculation: nuclear weapons. Iran currently enriches uranium to 60% purity, just a technical step away from the 90% required for weapons-grade material. International Atomic Energy Agency inspectors have largely been frozen out of key facilities. Iran's breakout timeline, the time needed to produce enough fissile material for a single nuclear device, is now estimated by US and Israeli intelligence at approximately 1 to 2 weeks, down from over a year when the 2015 nuclear deal, known as the JCPOA, was in force. Israel has made clear repeatedly and at the highest levels of government that it will not permit Iran to achieve nuclear weapons capability. Prime Minister Benjamin Netanyahu has described a nuclear Iran as an existential threat, not a strategic inconvenience, but a threat to Israel's very existence. If Iran were to announce or demonstrate nuclear weapons capability, the financial consequences would be unprecedented. We are not talking about an oil price spike or a shipping disruption. We are talking about a fundamental repricing of risk across every asset class in the global economy. Equity markets would crater. Treasury yields would initially spike as governments scrambled to fund emergency defense expenditure, then potentially collapse as recession fears overwhelmed inflation concerns. The already elevated defense budgets of every U.S. ally in the Middle East, Saudi Arabia, the UAE, Jordan, Egypt, would escalate dramatically. Saudi Arabia and Turkey have both signaled they would pursue their own nuclear programs if Iran crossed the threshold. The non-proliferation regime, one of the most important pillars of post-World War II international stability, would effectively collapse. The economic modeling of a nuclear Iran scenario produces numbers so large they begin to lose meaning. Some estimates suggest it could trigger a global recession deeper than 2008, with permanent structural damage to global trade and investment frameworks. This is the wild card. This is why every financial analyst who covers emerging markets, energy, or geopolitical risk has the Iran-Israel file somewhere near the top of their risk register. Is there a path toward de-escalation? And what would it be worth financially? The short answer is yes, and it would be worth an enormous amount. The Abraham Accords of 2020, the U.S. brokered normalization agreements between Israel and the United Arab Emirates, Bahrain, Morocco, and Sudan, demonstrated what financial integration between Israel and Arab economies could look like. Bilateral trade between Israel and the UAE alone went from essentially zero to over $3 billion in just 2 years. Israeli tourists flooded Dubai. Emirati investors poured money into Israeli tech startups. Airlines launched new direct routes. The economic dividend of peace was rapid and dramatic. Before October 7th, the Biden administration had been making significant progress toward an even more transformative deal: normalization between Israel and Saudi Arabia. Saudi Arabia is the world's largest oil exporter, the leader of the Arab world, and the custodian of Islam's holiest sites. An Israeli-Saudi normalization would fundamentally reshape the geopolitics of the Middle East, and with it, the economic risk landscape. October 7th and the subsequent Gaza war derailed those talks, but they have not permanently ended them. The economic logic is compelling for both sides. Saudi Arabia wants U.S. security guarantees and civilian nuclear technology. Israel wants broader legitimacy and access to Arab markets. The United States wants a stable Middle East that reduces its need for costly military engagement. If Iran were to be diplomatically contained through a revived nuclear deal, renewed IAEA inspections, and sanctions relief conditioned on verifiable compliance, the economic benefits for Iran itself would be profound. Iranian oil would re-enter global markets at full price. Foreign direct investment, particularly from Asian and European firms, would flow in. The rial would stabilize. Inflation would moderate. The Iranian middle class, which is large, educated, and deeply frustrated, would begin to breathe again. This is not a naive scenario. It is a scenario with genuine financial logic, one that multiple parties have real economic incentives to pursue, even if the political barriers remain formidable. For investors, business leaders, and anyone who manages money, even their own household finances, here are the key variables to monitor as this conflict continues to evolve. First, watch the Strait of Hormuz. Any credible threat to close or restrict this waterway is a Tier 1 market event. A full closure would send oil prices to levels not seen since the 1970s oil embargo. Second, watch Iran's nuclear enrichment curve. IAEA reports are published regularly. Any indication of weaponization activity, or any Israeli or American military strike on Iranian nuclear facilities, would trigger immediate and severe market volatility. Third, watch Hezbollah. The group's military arsenal, estimated to include over 150,000 rockets and missiles of varying range and precision, represents a potential mass casualty threat to Israeli cities that dwarfs anything Hamas deployed on October 7th. A full Hezbollah-Israel war would be qualitatively different from anything the region has seen since 2006, with correspondingly larger economic consequences. Fourth, watch the U.S. election cycle. American presidential administrations have historically pursued very different Iran policies. From the Obama-era engagement that produced the JCPOA, to the Trump maximum pressure campaign, to Biden's attempted but largely unsuccessful revival of nuclear diplomacy. Who sits in the White House shapes the risk environment significantly. Fifth, watch the Abraham Accords track. Specifically, whether Saudi-Israeli normalization is revived post-Gaza war. Progress on that front would be a powerful de-escalation signal for markets. The Iran-Israel conflict is, at its core, a story about power, identity, and survival. But it is also, inescapably, a story about money. Oil markets price in the risk every single day. Defense contractors build their business models around it. Insurance companies charge premiums because of it. Central banks factor it into their inflation projections. Investors hold extra gold because of it. And millions of ordinary people, in Israel, in Iran, in Lebanon, in Yemen, in Europe, in Asia, pay higher prices, earn lower returns, and live with greater uncertainty because two states, thousands of miles apart from most of the world's population centers, cannot find their way to a stable coexistence. Understanding this conflict through a financial lens doesn't reduce it to a cold calculation. It reveals exactly what is at stake. Not just for the combatants, but for all of us. The shadow war has a very real price tag, and the bill is still being written.